There's a lot of good that has happened in the state, in various communities around the state, and especially around the Metro Des Moines, where you and I both live. Understanding what has created those advantages and what has kept those advantages going is as important as keeping them going. Okay. Population growth is the driver for everything else that happens.
From cornfields to high-rises, office to industrial, houses to hotels, and every other asset class in real estate, we cover the people, the projects, and the profit. Welcome to the Investing in Iowa show. This show is for go-doers, action takers, and business owners. It's for people like you who are sick of Uncle Sam taking a huge bite of your apple. If you're looking to get ahead of what's taking place in Iowa, learn who is doing what, and how you can get in on the action, you're in the right place. Hosted by Neil Timmins, an Iowa native who has been involved in over $300 million in real estate right here in Iowa. Recording in studio from West Des Moines. Here's your host, Neil Timmins.
I've got Mike Macri here on the show. Mike, welcome.
Neil, how you doing?
I'm great. Say thanks for being here. For the audience's sake, remind them, because this is your second time back. Who are you? Where are you from? What do you do?
Yeah, so Mike Macri. I'm a vice president with CBRE, a commercial brokerage firm here in Des Moines, in the West Des Moines office. I've been doing commercial real estate brokerage now for over 23 years. I've been in the development world, property management, owner side as well. I'm a professor at Iowa State as well. On the real estate side, I teach in the College of Design, the real estate courses, and I teach the grad students in the master's program as well for the Masters of Real Estate Development.
It's not like you have anything going on.
Yeah. No, I don't like to sit.
Yeah, fantastic. All right, so it's been over a year since you've been on. The world's changed a bit. Let's start this. Give me an update. What's materially changed in your world, or from what it is you do in the real estate side of things and over the course of last year?
Yeah. So let's start with the definition on the real estate side.
Yeah.
Okay. I do commercial.
Yeah.
I live in the commercial world. That's the world I'm in. So on the housing side, things, it's not so much of what I deal with. Now, with that said, a lot of the economic drivers that you deal with on the residential side, we also deal with on the commercial side. Biggest one right now is population. And there was an article today in the Business Record that talks about population growth or lack thereof in the state and specifically certain markets that I paid very close attention to. Go back to 2000, 25 years ago. Des Moines has grown and the metro area has grown about 2% a year every year for the last 20 some odd years. I think it even goes back further than that into the 90s. Des Moines is one of the few markets that has had decades of continuous growth. And that's driven quite a bit of what has made Des Moines grow, change, and expand and get to the point now where we are on the precipice as an MSA of being at 1 million people.
Yeah.
We're just so close.
Yeah.
But article in the demographics that came out today, the state itself continues to grow, but it's really Des Moines MSA, including Ames, and it's Iowa City, Cedar Rapids, really kind of where your population drivers are. Everybody else is stagnant or going down.
Right.
That's a problem. And it's not a new problem, but it's a problem. Some of the solutions that have been proposed to drive more growth to small towns, to expand business into small towns, and to move economic incentives to small towns and to smaller communities, all that does is just cut the knees off of the economic drivers that are driving the state of Iowa's economy. Following the population and following the growth and where things are happening will help you understand where growth patterns are going to be, where demand patterns are going to need to be, where jobs are coming. These all aren't just residential things where you build houses. It's where the businesses are going, where the jobs are going, and frankly, where new business can grow and go because they need to have the people.
They got to have employees.
Now, with that issue of jobs, you look at what Des Moines has. The city of Des Moines, per the article this morning, actually decreased by 1,000 people, whereas Waukee, for example, has gone up 10,000. I think Ankeny is approaching 75,000. It's larger than West Des Moines. Ankeny was a small community when you and I were, coming up. Now it's one of the larger suburbs. The suburbs are driving the demand in the market. You have to look at what is causing that. What is causing the drive in the suburbs versus the core part of the metro. What are those changes? What is it that's causing those population shifts? As the population shifts, the demographics shift for employment, they shift for retail demand, they shift for shopping, traffic patterns change, road construction's needed. All these improvements follow those patterns.
You're totally right. When I think about some of the large corporate headquarters that exist, there's so many in West Des Moines. And you think, historically it's in the CBD.
Yeah.
But in some of these instances, especially when you get to a spot where the C-suite all lives in one geographic area and they're the ones who get to decide, cool, we're going west because I don't need to be 27 minutes from my job. I get to be 7 minutes from my job, and a tremendous amount of the employees are that general direction. Now that's certainly changed with Ankeny and then the eastern suburb, right?
Yeah. You want to talk about probabilities of growth and probability of change, okay? You mentioned West Des Moines. I think there's 35 banking headquarters in a 1 mile radius around University Avenue in West Des Moines alone, okay? It's an unbelievable number. You look at all the corporate office headquarters that are located in West Des Moines. Take that same analysis and look at Ankeny.
It's like it's a polar opposite.
Exactly. Ankeny was a bedroom community.
Yes.
Now it's larger than West Des Moines.
Yes.
Some of the largest residential properties in the entire county, in the area, are in Ankeny. Probability. I don't know anything. I have no inside information on this. Some business owner that lives in Ankeny or in that area is going to move a headquarters there just because it's closer to where they live and they don't want to go out to West Des Moines.
Yes.
And that's not saying anything bad about West Des Moines. No. It's not saying anything bad about downtown. You are going to work closer to where you live. Ankeny has built itself up as a residential community, but that employment base and that corporate employment base behind it hasn't grown in the same way as West Des Moines. Just look at the dynamics and the population. That is going to happen.
It's only a matter of time.
It's only a matter of time.
Yeah.
It's only a matter of time.
Anything. I mean, the trajectory where it's heading, that engine is chugging, man. It is moving, and people keep ending up there. I love this whole place, right? But what a terrific community, and the way it's grown up around itself.
It's unbelievable. Yeah. And
very impressive.
You look at all the suburbs, down from what Norwalk's doing, from what Altoona, what Pleasant Hill is doing, what Grimes is doing, has done, and continues to do. Johnston, Urbandale, all these communities, they each have their own little nuances of how they've put their spin on economic growth and how they've built a case study or a message to their citizens and to potential future citizens and corporate citizens of why you're going to build there. They each have their little niche of what it is. You can look at all of the ones that are out there and the ones that have worked the way that you as a city official or as a business owner are looking at. And you can say, here's why I want to be in these markets. Here's why I want to be in these communities, because these are the things I'm looking for, whether that's employment base for manufacturing jobs, whether that's employment base for high-end office jobs, whether that's mid-level employment, whether that's school district that attracts in other people, whether that's access to amenities, walkability, entertainment. Each community has their niche. It can even go to housing prices and say, we're going here because housing prices are lower and our employment base wants to own, they don't want to rent, and they want these economic incentives.
Yeah. All right. So Ankeny and corporate headquarters, and I'm in total agreement with you. But what won't happen anytime soon, in my opinion, is nobody's going to go spec an office up there anytime soon.
Nobody's going to spec office anywhere, period.
Yeah.
It's just it. Now, I made the comment end of last year. If you look at the demand for office space, you look at the demand of what's happening in the office market, I think we've hit a lull end of last year. Now, that doesn't mean it's going to be a boom like it was the end of the 90s, but the demand is growing for some employers are expanding. Okay. Some are still downsizing, but moderate incremental growth and year over year of just needing to fill space. You'll see that growth demand. The irony of that argument, the demand for those spaces is targeted around the amenities. It's targeted around the presence, the feel, and keeping the employees wanting to come in and happy while they're there. We talk about the housing market. We talk about where people want to live. They want to work close to where they live. Okay, take it a whole other step. You look at the job force as they're coming out of college. They're used to working in open environments. They're used to having phenomenal living arrangements, facilities, things that are accessible to them. They then come out of school. More often than not, they're moving in an apartment building. What do they have in their apartment building? They've got game rooms, they've got pools, they've got walking trails, the fitness center. Everything's great. And they love it, and they can be there. They're going to leave there, and they're going to go into a white box, enclosed space, cubicle land, and spend all day there. Why can't I just work at home? So the office market has then transitioned to say, okay, we are going to offer these amenities. We're going to offer a space that provides the same environment as you would have at home to keep you happy, keep you coming in, and provide it as an amenity to the employees to keep them in. The spaces that have offered those amenities and that have adapted to those changes are the ones that are filling. The ones that are functionally obsolescent or are built to a standard that is not desired anymore are the ones that are having problems. And those are the conversion opportunity.
Hey, Iowa investors, this is Ava Baukamp, Chief of Staff at Legacy Impact Investors. Have you thought about adding real estate to your portfolio but don't have the time or desire to play landlord? At Legacy Impact Investors, we do the heavy lifting. Our team finds the deals, manages the properties, and handles all the day-to-day operations. Our select group of qualified investors co-invest with us, gaining ownership equity without opening a tenant email or responding to a maintenance call. They just share in the income, appreciation, and tax benefits. These opportunities aren't for everyone. They are for qualified, accredited investors only. If you want to learn more, please visit legacyimpactinvestors.com to apply.
Yeah, so those are the ones that pop up and you go, cool, how can we repurpose this into something else?
Exactly.
You do a lot in the industrial world. What's taking place? I read the headlines. I'm sure I keep up on the business record and see what's taking place out there. It seems to me like the smaller spaces, those have probably historically done well, and certainly they do really well today. Some of those bigger spaces, that need for that 50 or 100,000 square foot user is not what it used to be.
Des Moines, as far back as you want to look, is a 20 to 50,000 square foot target market space. Those are the users that we have had as far back as you want to go. Okay. Even the quote big buildings back in the 80s were 50,000 square feet. Okay. But look at the businesses that primarily operate out of the metro. They're in 20 to 50,000 square feet of space. Some of them might be multi-tenanted larger buildings. Okay. But you're in these spaces. For years, that was the bread and butter. That was what was built. Those were what were leased and marketed. And you started out in 3,000 to 6,000 feet, and then you took a demising wall out, and you kept expanding in the building until pretty soon you get the whole building. Right. Okay, but that sweet spot is where the Metro of Des Moines has lived for decades. Yeah. Okay, we got away from that in 2012, 2013, 2014, and for basically the last, call it 10, almost 12 years. Yeah. We got away from it because it was necessary. There was a demand for higher cube space and bigger buildings, basically accommodating the 3PL, third-party logistics companies, and those warehousing of products and the Amazoning of the market. That hasn't stopped, but we're not adding 2 million square feet of that space every year anymore because the demand for that extra space has stabilized. The demand for the 20 to 50,000 foot space hasn't stopped. It's just people forgot about it for a decade. And now the demand is there, but you can't build it the same way you could before.
No, and that's because from a lease rate standpoint, they can't afford it.
They can't afford it on the lease rate, and the cost to do it doubled. So if I'm looking at the lowest cost option for constructing industrial, I'm still going to look at a larger footprint just because of the economies of scale. But if I'm the tenant, I say, I don't need 100,000 feet, or I don't need a 300,000 foot building that I can only take one bay in. And then if I'm the developer of that, I don't want to have to demise my 300,000 foot building and put in 250 to 500,000 foot demising walls, $500,000 demising walls just to split the space with splitting electrical, extra fire suppression issues, all the management that comes along with it versus having a single tenant building. There's an absolute need for those larger buildings. There's a need for the operation of those as single tenant buildings. The demand for the bread and butter of the Metro of Des Moines hasn't stopped. It hasn't changed. It's just the cost to do so hasn't, the ability or willingness to pay the cost to do so hasn't kept up.
So how's that play out? rents continue to move on this call it second or third generation space to the point where sooner or later there is so much demand. Rent rates have been driven so high that the cost is now, your risk reward, if you will, to build now makes sense. And that's when it takes place, because you're not creating any more, you're not creating inventory that's 20 years old.
No. The clients I'm working with, okay, they see if I'm going to build a 50,000 foot building, it's going to cost me significantly more than I'm willing to justify. I'm not saying they can't do it, that they're willing to justify to pay.
Sure.
Okay. They will fight it out in a smaller space, do what they need to do to accommodate a smaller space as long as they possibly can. And then rather than back in the day where they'd go from 40,000 feet to 50 and take the next bay, they're going to go from 40 to 200. And they're going to say, we're going to bring everything in-house. We're going to put it all in one place, and now we can accommodate it. And so those incremental increases that with traditional lease terms of 5 years, you could see the cycle. Every 5 years, they're going to add 10 to 20% of space. That's not happening as much because the cost of doing that doesn't justify doing it. Now, we're going to be in 40,000 feet. We're going to suck it up for 15 years. But then when we make that switch, we're going to go to 120 and we're going to make that move. And that's a somewhat of a shift historically in the market. But in the last 5 years, that's what you see. And you see the users that are taking some of these buildings that aren't the 3PLs. They're coming out of a lot less space than what they're in. And it's not that incremental shift.
What's coming in the pipeline in terms of new development supply and vacancy? And it seems like where the vacancy exists in the marketplace, it's largely in new deliveries.
Mm-hmm.
And it's largely in what you said, these 100,000 square footers. It's minuscule in these sub 50 and an older generation.
If I remember right, and I'm going off the top of my head, CBRE's vacancy report for industrial, I think, was around 5 or 6% for the market for the last quarter. Okay. That is a little higher than it's been for the last couple of years, but still nobody's going crazy. Okay. Look at what's vacant though. It's a very, very small number of properties. Look back 10 years and you say, if you had a 5% vacancy in the industrial market 10 years ago, you may have 50 buildings available.
Sure.
Now it's 4. You have the same amount of square footage, significantly fewer buildings, and those buildings cannot be demised in the same way that you can a smaller building that we would have traditionally seen in the market in the metro. And so in that way, the reports skew the reality. Yeah. If I'm looking for 20,000 square feet of space, I have a grand total of like 4 options. If I'm looking for 100,000 square feet space, I may have 15 options, but those 100,000 square feet spaces can only be 100,000 foot spaces. You can't demise them to fit in a 35,000 foot user per se. That's the part that I think when you look at the marketing reports that come out, and this is from any of the firms, the information is slightly skewed in that way, where you don't realize, wait a minute, there's not as many buildings. It's just 4 buildings.
Yeah, I think that's when you look at certain asset classes, that's the one thing that stands out to me the most about industrial.
Yeah.
Is just so, when you got to peel back that vacancy report to dive into to go, all right, what does it really mean?
Yeah.
And where is really taking place?
I remember an example of this some of the construction of the larger buildings we have now. Years ago when R.R. Donnelley closed their plant on Park Avenue on the south side, and that hit the market, it hit the reports. All of a sudden, the south side industrial vacancy spiked by like 70%.
Sure.
Just one building. It's not a terrible place to be. There's still great things to do. It's just one building's on the market. You have to go off more than just the headline news and dig in the information a little bit and understand that the supply is still tight if you're looking for certain things.
What's in the pipeline? Because it seems like last time we were here, things had slowed dramatically in terms of what's going new construction in the pipeline. And to me, it seems like probably more so even now.
Yeah. So
it's just continued because interest rates really haven't, from last time we were here.
Well,
it moved a little. But
so here's the thing. It's not even just interest rates. Interest rates have effectively stayed the same from where we were last time. Cost of construction is up 20%-ish. Code compliance and code requirements for certain things is increase those costs as well. You haven't seen a decrease in cost, and land costs are still high. You haven't seen a decrease in costs. So there hasn't been a rush to continue to build the way we saw, 3, 4, 5 years ago. We're at a point now where the lack of construction is going to create a demand just because the space that's there, even like we talked about, it's 3 or 4 spaces, they're filling. They're going to be full. Okay. There's nothing coming in the pipeline for the next, call it, year that will be able to backfill that supply. So all of a sudden, you're going to be looking for 30, 40, 50, 100,000 square feet of space. You may have a lease that's coming up for renewal. You don't have any options. You don't have the options. And it's going to create a spike in demand. It's going to create a spike in pricing because of the lack of new construction.
How does that play out as it relates to the trades? Because as there's real estate investors, some of us will just go, okay, we'll just, you sit on the sideline, you hold your capital, you wait for something else. But those in the trades, they don't get to do that.
No.
If they don't have work, they have to have work. I mean, they find a new profession. They go do something else.
The GCs.
So some places.
Yeah.
I wonder, the number of GCs draw down and underlying the GCs are all the trades who do all this work.
I don't think
how does that come back?
Yeah.
And then how does it affect pricing on these things? Because you would think, right, someday the pricing will come down because it's good on the labor side. And I've been hearing that some of it is taking place today. But at some point, the GCs and some of the subs are just going to be out of business. There's only so far you can cut a price before you're like, there's not enough work.
Yeah.
I got to find something else.
The GCs I talk to, pricing is stabilized to coming down just because of labor costs, and the margins have come down. Okay. The material cost though isn't really changing.
Yeah.
The cost to buy lumber, now lumber commodity prices are down from what they were a while ago, and they continue to go. That's great. Okay. Look at steel, look at aluminum, look at copper, look at wiring, look at what it takes to get an electrical component shipped to you. Look what it takes to get an electrical panel put in. These things aren't cheap still. Okay. I do not see a 08, knock on wood, type of market where all of a sudden everybody's not working. I don't see that. It's going to be different. It just changes. Rather than having crews that are working on 300,000 foot buildings all year, you might do 650s, and it's going to be owner occupied. It's not going to be you're working for a developer and putting tenants in. XYZ company is going to build their building and they're going to occupy it. It gets back to the way we were forever, pre-2012.
Well, the industrial market it's maybe give some color relative to the percentages, but depending on the business, tremendous amount of businesses want to own their real estate. They don't want to lease. They want to own that. And if you get into an environment, it would seem like where that cost of construction is high, therefore there isn't a bunch of people doing spec stuff. Your options are really limited, and the owner at some point just goes, cool, my options aren't out there. We'll just go build.
Well, you
option.
You talk about interest rate costs.
Yeah.
Okay. Interest rates are one component to the financing costs. Right. More than anything, the amount of leverage you can carry as an investor versus owner occupied is markedly different. An owner occupant can carry more leverage on a project. They can also use that leverage to do their improvements and to capitalize some of their improvements they need to make in a way they can't as a tenant. Vice versa, as a tenant, if I've got to go put $1 million in office improvements in, which sounds like a lot of money, it does not take much to get there anymore. You're going to do $1 million improvements. I've got to almost come out of pocket for that, because the getting of the financing as a tenant to do those improvements is so much harder than it was even 5 years ago. Those improvements are very, very hard to get. And so I can say, look, I'm going to own the building. I'm going to take on the same risk I would have taken otherwise. I can capitalize the work I've got to do in a different way, and it's going to actually cost me less than if I go rent the space. That's where the shift is going to happen in the market that I see. And this isn't just on the industrial side. Yeah. You're going to see this in retail, in office, in other types, because of how that debt has to be financed and the collateralization of those improvements. It's just really hard to do it on a leased space.
Yeah, it's hard to do it on a leased space. Yeah, I would think you see it in office and for sure in industrial. To me, that national retail may not be so much. So give me some thought there. I'm thinking of build a strip mall, and you got the AT&Ts where you got all these people who are coming in, they're all nationals, and they just need the one more space. They just pay whatever the heck the market happens to.
They're not
to say they have a blank check. Their growth comes from in certain places, restaurants come to mind. They got to build it. They got to do the next location.
Yeah. You're talking about a corporate store.
That's right.
Different animal.
Yeah.
Different. Then frankly,
They're covering it all.
Then even the franchisee. The franchisee may have 30 locations. They're still financing every one of those in some way, shape, or form. And if you're at 5 or 6 or you're putting in a location, it's like, I can't do that. And if you look at all of the retail, the smaller neighborhood style retail centers, so many of those are operated by a smaller franchisee or just an independent operator. Financing of those improvements is still a problem. Like you said, if you're an AT&T, you're a Verizon, you're a Chipotle, not a problem. Your mom and pop shop, different animal.
Talk to me about Iowa State. Talk to me about where the program was before you got in and your involvement there.
So here's the fun part about that. The program before I got involved was non-existent. I was in the first cohort of students that joined the program. So I was at ground level as a student going into the program. It took about 20 months to get through the Masters of Real Estate program. And then coming out of that, I chose to remain involved, help out however I could, do what I can. That has now expanded to where I'm a professor of practice and I'm actually teaching the real estate courses. So I've got the real estate development course that I teach for the graduate students, which I'm doing this fall. I've got one that I do for the undergrads, for the graduating seniors. I've got a course on community development and the community economies where I work with future city managers, planners, and their students to help them understand the perspective of here's what the developer is looking for coming into a community. Here's what the community's codes, regulations, and zoning calls for. Here's how you balance those two. So the future city officials understand what the private development is looking for and can work accordingly. Last fall, I wrote 5 more courses that are still waiting to be approved in various other components that would add to the program that I won't teach them all at the same time, but they would be available then. But there's one that's up for an experimental designation right now. It'll be land planning and development. Go from bare ground and talk about land planning and just the master planning of sites.
There are certain aspects of degrees. Certain degrees have aspects of this that are totally practical. You can just go, cool, graduate, got my thing, and I'm going to go plug into this, right? This, to me, a lot of stuff you go through, you can plug into. There's a direct employer out there who's doing exactly what it is. You're a practitioner of this.
Yeah.
It's like, I'm teaching you what I actually do.
Yeah.
Right. What the people out there, the developers, are actually doing. And there's a need for employees who can bring a skill set to be able to go put into practice.
So my first classes started the fall semester of 2019. First class graduated in May of 2021. So we're just now getting to kind of that 4-year period where there's 4 graduating classes that have gone through. I had a great experience 2 weeks ago where I had one of my prior students come back and got to speak to the class, which was just fun for me. And I know he thought it was awesome as well. You're starting to see those Masters of Real Estate Development, those MRAD students popping up in the market, and not just around Des Moines. You're in Peoria, Illinois. You're in Minneapolis. They're on the coast. I've got a student in Kentucky right now in my classes. You're seeing those students around the Midwest and around Des Moines, and they are starting to be very, very prevalent in their markets, in their industries, and in their companies. And you're going to see more and more and more coming out of it. For me, it's really exciting to see that happen.
If you're a house flipper, execute the burst strategy, or do double closings and are in need of money, Little Guy Loans is your go-to lender here in the Des Moines area. Time is money. Loan approvals in 24 hours. Closings in 5 days. Little Guy Loans was founded by Neil Timmins, an investor just like you. Since he has been in over 10,000 homes in Des Moines, there's never an appraisal. Houses, multifamily, and commercial property loans up to $1 million. Check out www.littleguyloans.com.
When you look forward, say 5 years, 10 years from now, where's the program go? What do you want it to look like? What is everybody in the organization,
Yeah. So the MRAD program right now is you really have kind of a dual path where you're going through the College of Business and the College of Design simultaneously. So, and I say simultaneously because you start and you get processes from site selection and demographic analysis. There's market analysis you'll go through. You'll understand the financing behind real estate development and ownership. And you'll also go through some of the college in engineering with construction engineering, project management. You'll go through the design and the understanding of the design. You can take electives on historic restoration, on various other components as you go through and pick and choose where you want to go. And then your capstone courses are where you have a final project you're working on and you're presenting it as a real thing. You get to experience and touch all aspects of real estate. And I don't even want to say commercial real estate. There's professors in the program that are more focused on the residential side. So it's not just commercial. You can get into flipping houses and you want to know more about the process. You can go do that. You can do residential development. You can do, high-rise commercial development. Yeah, it's a very unique program nationally. There's only a handful of MRAD programs nationally. Right. Around the Midwest, I think Wisconsin has one, and I think Minnesota might have an undergrad program. And then obviously UNI has got a great undergrad program. This is what I'm doing at Iowa State is strictly on the graduate side.
It's exciting. All right, so give me your crystal ball. You look forward to the next year. Is anything materially different?
No. Yeah. It's going to be a rinse and repeat. Now, it's rinse and repeat, but that doesn't necessarily mean it's going to be the same thing. It means the trends, the things that are happening are going to be exacerbated. Then you're going to keep seeing more and more and more. One we talked about a couple of weeks ago, just on a sidebar, is the return on investment of investment property. That's not going to change. Cap rates aren't going to go down, but incomes are going to go up because costs of construction are going up, rents are going up. Those are going to go up. Your return, though, as an investor really isn't going to change. So the cost differential between just getting a muni bond that's double tax free versus investing in a triple net lease, there's more benefit in a lot of cases to just doing the muni bond, unless you really, really, really want to own that property. That isn't changing in the next year. That's not going away. So understanding the investment side and what actually creates value and what actually compensates you for the risks that you are taking on as the investor, that's the one that is really hard to cover right now. You are not properly compensated for the risk that you're taking on. And I think many people are overlooking that part.
Perspective of a historical standard.
I say it from the perspective of as an investor. Think of
meaning historically the risk premium, your yield spread over what you borrow at has historically been wider than what it is today.
Correct. And I'll give you a couple examples just to think through that. When I teach my class, one of the things I talk with students about, because not all the students are financially astute and very few of them have gone through a lot of financial classes. We've got a lot of students that are kind of fresh to this. And so I'm one of the first people that go into it. The concept of a cap rate. It's a common concept. It's a common term. Sometimes people hear it, but they don't realize what it is. The idea of a market cap rate is strictly an average of what other properties are sold for. It's not saying this is what you got to get. It's saying this is what the market says on average of what you're going to get. The capitalization rate that you're getting on your property is a static number. It's based on 1 year's income. It's not based on a drawn out pro forma. That's your internal rate of return. But that cap rate is the rate of return that you are going to receive on this property. If that is too low for you, it's not acceptable. Doesn't mean you have to do it. It means it's not right for you. Okay? Sometimes people forget that. They say, well, market cap rate is 7%. Great, but I need a 9 because I'm paying 7% interest. When we are paying 3% interest rates and you're getting a 7% cap rate, that 4% spread starts to make sense with all the other benefits you get of owning property. All day long. Yeah, you know what I'm talking about. But when I have to pay 6.5% and I'm at a 7% cap rate or I'm at a 6% cap rate, I'm not gaining any return for that debt that I'm also carrying as a risk as the investor in the property. The cost benefit analysis really starts to wane.
It's very hard to justify new money going to work there, right? If you're coming out, you're exchanging out of something, and you want to play that mental game and do the math to figure out, can I justify that? But to justify new money going in at a negative leverage piece.
How about this? Even coming out as an exchange, I can put $2 million into a double tax-free muni bond investing in LAX. Los Angeles International Airport. Or I can put $2 million into a franchisee on a 10-year lease that's owning a building in pick the street, Iowa. Okay. The double tax-free muni bond is going to pay me 6% coupon rate. And with the taxes, depending on your income tax rate, you're going to be between an 8 and 8.5% rate of return. Or I'm going to own this triple net investment with a franchisee who I'm praying to God pays his bills every month. I'm going to get maybe a 6, and I'm paying 6.5% interest on it, meaning I'm only getting a rate of return really on the equity I put into it. I may end up at a 4% rate of return on that. Pay the tax. Pay the tax. Unless you are so upside down and you've on your basis, pay the tax.
You're saying pay the tax and wait for another day.
Pay the tax and wait for another day.
Because historically, it looks different than this.
The risk that I'm carrying of that business performing, how about this? International building codes change in 4 years. And now I have to repurpose that building, and I've got to redo that building for the next tenant. And the cost of renovating that building just to building codes exceeds what my return was for that period of time. Where's the benefit as an owner?
Yeah, having a historical perspective and looking a little further back can shed a new light on things.
Yeah.
What keeps you up at night?
All of the above. What keeps me up at night is population growth. Where do we go next? Where's the spots to start building and start growing? Buildings are going to go up. Things are going to happen. Things are going to shift. You're going to be able to get projects done. Okay. I'm not in any way, shape, or form. I'm going to preface this from what we talked about. I'm not pessimistic on the market. Okay. It's just going to be different. It's just going to be different. So every development project, every investment project, every deal, every tenant relocation has a myriad of different things that go into it. The biggest one right now is population growth.
Is it fair to say that's why you're optimistic, is because of the population growth?
I'm both optimistic and I'm pessimistic because the markets that should be the best, when you have that statewide growth that drops below 2%, for me, that's a red flag.
Interesting. Why is that? Why is it important that the state grow, but not necessarily a municipality or an MSA grow?
An MSA will grow in things, but Iowa's economy is actually the number one driver of the economy is manufacturing. Agricultural is close. Everybody always thinks of agriculture, but it's actually manufacturing. Okay. If our population is not growing, the job force isn't there. The growth that's coming into the markets isn't there to suck up the supply that's there, the housing that's going in that doesn't drive further demand. That population growth has a multiplying effect on so many other industries that are cursory, but not necessarily directly tied to it.
So how do we get a population to grow? Iowa is one of the oldest states in this country. Florida's older, I think, but there aren't many states past that and have an older age population. Rural Iowa continues to die. It's going to continue to slide. The robotics that's going into the ag industry, the way it's headed, a farmer can farm so many acres, it's going to be ridiculous.
So let me ask you this question. I'm asking you this question.
Yeah.
Is that a problem?
Is it a problem? Well, we're going in a population standpoint. That's where I'm going with this. It has to. Ultimately, it's a shift. So to your point, it's different. The city centers, the population centers in this state have to continue to grow because that's the only place the population's coming.
That's the place the population's coming.
Yes.
Okay.
And so we got to add bodies. There's got to be jobs.
But think about those even rural city centers. Okay. Your communities of let's go 10,000 people on average.
Yeah.
Okay. What's driving someone to a 10,000 person community anywhere around the state? And this is going to be true in any state you go to, but let's focus on Iowa. Yeah. Okay. What's driving somebody to that community?
There's a manufacturing facility somewhere. Because they're not 10,000 people in a rural Iowa. They aren't in ag.
No. There's a
ag manufacturing. There's a manufacturing
facility, one or two in those communities. Okay. Not only that, what's driving the people to live there?
I would think it's small town life. It's extraordinarily affordable.
Small town life, school districts, jobs. Those are the things. Okay. So when I'm working with a community or when I'm working with a client or working on a project, and you're thinking about what is it that's driving this community? So many of the communities say, well, we want these restaurants and we want these shopping and we want these things. You're not going to get them. You don't have the bodies to support doing it. Yeah. Now, that's not necessarily a bad thing. It gets back to how the various municipalities market themselves. What are the benefits that you offer that are unique to you? You can offer a quality of life that is not possible if you grow to a certain size. It is a thing about it. There is something that you can offer that you can't do in a larger market. Okay? You might be 15, 20, 30 minutes away from a larger community, but the school district you can offer things in schools that you can't offer in other markets. You can become a magnet in that case. You can offer things as it relates to civil opportunities in a community that you can't offer in other markets. There are things that can be done that creates that market demand for a smaller community. 2% is 2%, but it doesn't mean it's 20,000 people. All it is, it's showing retained growth and showing that things. You're not going to get some of the amenities that you get in metros like Des Moines. Des Moines doesn't get things you get in Kansas City. It's not happening. There's no, we are a AAA market and we do it very well. Extremely well. Okay. But that's what we have. And I can go to a game. I can take my kids to a game and it's even really good seats are $10, $10. What was the article that came out last week? The average family ticket price for an NFL game was like $750. Want to go to one game. We don't have that. We are a AAA market. That's not a bad thing. It's just what it is.
Right. Yeah. The communities, sell what you got.
Understand what you have.
Yeah. Correct.
Understand what it is you have. Understand what benefit that you bring that is different from other places and sell that. Yep. Don't try to rinse and repeat what everybody else is doing because this is what you know. Understand what you got and understand where you want to go. If you say, well, we want to add more people, but we want to keep small town life, you are going to have a real hard time.
Mike, I've asked tons of questions. This has been a fantastic conversation. What's one question I did not ask that I should have asked?
There's a lot of good that has happened in the state, in various communities around the state, and especially around the Metro Des Moines, where you and I both live. Understanding what has created those advantages and what has kept those advantages going is as important as keeping them going. Okay. Population growth is the driver for everything else that happens. If you want to bring in more jobs, you have to bring more people. If you want to bring in more people, you got to bring in more houses. You don't bring in the houses until you got more people to buy the new houses so the old people move out of the old ones. Population growth is the foundation of everything that has been good about the growth that has happened in the metro for the last 25 years. Once that starts to slip, you have to analyze why. What is it that is slipping and how do we correct that before it becomes a problem?
I think demographers are some of the most interesting people, and the studies they put out are terrific to be able to dive in and analyze because it's simple supply and demand. If you got more people coming in, you're heading in the right direction. Amazing things take place. Not just in real estate, like everything, but there's a net benefit to the whole community. For people who want to find you, follow you, connect with you, where can they go? What should they do?
You can find me on LinkedIn. I've got a LinkedIn page, obviously. You can find me on the CBRE's homepage there. I try to keep my face out of most things until you call me and want me to come do this. But otherwise, you can reach out to me on LinkedIn, at CBRE, at Iowa State. Emails and everything are available there as well. And for those of you that are considering expanding your educational prowess, I tell you to come look at the MRAD program and see if it's something for you.
On the show notes, Mike, thanks for being here.
Thank you very much.
Thanks for listening. If you're enjoying the show, may I ask a favor of you? Naturally, subscribe so you never miss an episode. But would you rate and leave an honest written review on Apple Podcasts? It does a lot for us here at the show, and I appreciate reading your thoughts. Great guests make for a great show. If you know of another Iowan who would be a great guest, or you yourself have interest in being a guest, well, get on our radar. Visit Investing in Iowa to fill out an application or recommend a guest. And if you want to connect with me one-on-one, go to LegacyImpactInvestors.com. Click on the Invest With Us button in the top right corner, and there you can pick a time for the two of us to get on the calendar and connect. Until next time, keep investing in Iowa.